Hello, in this video I will be talking about Chapter 5, Learning Objective 3, Cost Volume Profit Analysis. In this section I will be trying to teach you about cost volume profit analysis and what it is used for, along with the formulas used in this section like the contribution margin and the contribution margin ratio. I will also show a CVP income statement and an example of how it looks and how to fill in a basic one. Cost volume profit analysis, or CVP, is something companies use to figure out how changes in cost and volume affect their operating expenses and net income. CVP works by comparing different relationships such as the cost of operating and producing goods, the amount of goods sold, and profits generated from the sales of those goods. By breaking down costs into fixed versus variable, CVP analysis gives companies strong insight into the profitability of their products or services. CVP is used in many companies. Accounting professionals use cost volume profit analysis to make informed decisions about the products or services they sell. CVP analysis plays a large role in managerial accounting. It focuses on helping managers or those tasked with running businesses make smart, cost-effective moves. When managers use CVP analysis to make business decisions, the following assumptions are made. All costs, including manufacturing, administrative, and overhead costs, can be accurately identified as either fixed or variable. The selling price per unit is constant. Changes in activity are the only factors that affect cost, and all units produced are sold. When these assumptions are not valid, the CVP analysis may be inaccurate. So, contribution margin is the sale price of a unit minus the variable cost involved in this unit's production. It is used to find an optimal price point for a product. It also measures whether the product is generating enough revenue to pay for a fixed cost and determine the profit it is generating. The contribution margin can be calculated in dollars, units, or a percentage. Additionally, the contribution margin is used to determine the break-even point, which is the number of units produced or revenues generated to break even. The contribution margin ratio, on the other hand, is a percentage of differences in a company's sales and variable expenses. Variable expenses are subtracted from the sales to isolate profit and fixed expenses. This ratio then explains in percentage form the amount of revenue that is profit and fixed expenses. The formula for contribution margin is net sales minus variable cost. And the formula for contribution margin ratio is sales minus variable expenses, and then you divide sales to get the ratio. The contribution margin is the foundation for break-even analysis used in the overall cost and sales price planning for products. The contribution margin helps to separate out the fixed cost and profit components coming from product sales and can be used to determine the selling price range of a product, the profit level that can be expected from the sales, the structured sales, commission paid to sales team members, distributors, or commission agents. In this example, Vargo Video Company sells 1,600 camcorders in 1 month. Sales are 800,000 and the variable costs are 480,000. So in order to get the contribution margin, what we do is take sales of 800,000 minus variable costs of 480,000 to get the contribution margin, which is 320,000. So in the last problem, we had $500 for sales and $300 for variable. The contribution margin is then available to cover fixed costs and to contribute income for the company. The formula for contribution margin per unit is shown here. Here's a screenshot on a homework problem that had us complete an income statement. When beginning to do an income statement, we start with sales, which is 360,000. To get that, we do unit selling price of security control, which is 45, times units sold, which is 8,000, to get 360,000. The next step is to get the variable cost. Now we do unit variable cost, which is 22, times units sold, which is 8,000, to get 176,000. Now that we have the sales and the variable cost, we subtract those both to get the contribution margin, which equals 184,000. But to make sure that's correct, you subtract 45 from the unit selling price and the 22 from the variable cost to get 23. If you do 23 times 8,000, you should get 184,000. The next step is to add in the fixed cost, which is 120,000. Once added, you subtract the fixed cost from the contribution margin to get the net income, which equals 64,000. Coming back to the Vargo video problem, because Vargo video has a fixed cost of 200,000, it must sell 1,000 units to cover all costs, which would be the break-even point. For each unit sold above 1,000, the net income increases by 200. That's the per unit contribution margin. So in the picture to the right, we see that if they sell 1,001 units, they make a net income of $200. Some managers prefer to use the contribution margin ratio in CVP analysis. The contribution margin ratio is the contribution margin expressed as a percentage of sales. To get the percentages, you do contribution margin, which is 200,200, and you divide that by sales of 500,500, and you get 0.4, which becomes 40%. Sales has to always add up to 100%, so then variable cost would be 60%. The contribution margin can be determined by dividing the unit contribution margin by the unit selling price. So you can also do unit contribution margin of $200 divided by selling price of $500 to get 0.4, which converts to 40%. So in this video, I talked about learning objective 3 in chapter 5, which covered cost volume profit analysis, and what it is used for, along with the formulas used in this section, like the contribution margin and the contribution margin ratio. I also showed a CVP income statement and an example problem from our homework.